Good morning and welcome back to the latest edition of the InvestTalk Market Analysis for the week ending December 8th, 2023. Appreciate you all tuning in to this channel, liking and subscribing. And today I'm going to title the video, Small Cap Stocks Come Back to Life Heading into 2024. And we only have a few weeks left in the year, and we're going to dig into some economic data as well as the charts. I'm host of InvestTalk, Justin Klein, and the economic data this week was a bit mixed, but I would say modestly positive. Durable goods new orders, which and this is for October, so it's a little bit backwards looking, but at the same time, new orders is always forward looking. And so that did weaken in the month of October, down over 5% for the second time in 4 months. The ISM services index that came in a tick higher. And if you look at the sub indices, new orders came in at 55.5. That was flat, and as we said before, that does portend to a decent demand going forward. Remember, services is the vast majority of our economy. About 3/4 of our economy is just the services side. So this is more important than the manufacturing side. Although a lot of people focus on that, the employment index, the ISM services side is certainly the one you want to watch more than manufacturing. The employment index did tick up just a bit. Remember, the month of November was a huge drop in the financial conditions, huge increase in financial conditions, meaning things were a lot better for throughout the month of November with the dollar weakening, with interest rates coming down. That is going to be a tailwind to economic activity. So looking at November numbers, there is a bit of color of a better backdrop, and that's why you're seeing a bit of strength, I think, in the November numbers. Prices paid index that did continue to come down 50.3 pre-pandemic, 58.3. Pre-pandemic, we were at 59.3 in December of 2019, 55.5 in January. So, you pretty much have a round trip on inflation. And then you have the employment data. This is probably the most important that I watch. A lot of people focus on the continuing claim, or the initial claims for unemployment. It's not just about that. It's about how many people lose their job and then stay without a job for an extended period of time. That ultimately impacts their spending. If you lose your job, you're out for 2 weeks, you get a job again, no big deal. That typically for most people isn't a huge game changer. So this is above 1.8 million, and that is a level that does show relative weakness in the labor market. So that's something I'm watching. You had a big drop in the final week of November. So we'll see what that looks like as we go into December. Now, the non-farm payrolls came out yesterday. That beat expectations of about 175, came in at 199. Average hourly earnings did tick down. So obviously that helps the inflation picture and something the Fed is going to continue to watch. Unemployment rate did tick down as well from 3.9 to 3.7. So that was a positive. Overall, there was a bit of a shift in Fed policy expectations. Nothing for this meeting coming up on Wednesday or the month of January. That was pretty much locked in for a pause anyway. Now, there was a 14% chance a week ago there would be a cut in January. Now it's only 4%. So from that standpoint, a bit more hawkish move built into Fed expectations. Same with March. You now have only about a 45% chance of a Fed rate cut in March. That was a lot higher a week ago. That was 55% chance of one cut, 80% chance of another. So talking about 63% chance, and that's gone down to about a 45% chance. So not a massive move, but certainly of note. Okay, so let's dig into the charts, and we'll start with the S&P here. And you can see it's closed at a new high for the year. Okay, new high for the year. Now, we're not above the 2021 highs, but it is a new high for the year. And I think the market's going to get ready to attack those highs. Now, probably not before another pullback. At some point, maybe first quarter, we're expecting latter part of the first quarter to be where the next bout of potential volatility will happen. We're going into Santa Claus rally. Now we're kind of front loaded that with the last few weeks. You're talking about 6 straight weeks in a row up. that does typically bring a pause. So do we get a pullback next week? That would not shock me at all. It's option next week. We have the Fed news that could bring a bit more volatility, especially the Fed speaks a little more hawkishly, focuses on maybe higher for longer, which they've been talking about. That certainly could bring a bit of volatility into the markets. Now, the dollar is the big news that has rolled over. It tested support here at the 100-day moving average. Got a bit of a bounce over the past week, and we will see what we get after the Fed meeting Wednesday, but that will certainly be a big marker of where the asset prices are likely headed. The 10-year did get a boost up on Friday, closed at about 4.25 on the week. So overall, roughly, let's see where we're at, 1, 2, 3, 4, 5. Yeah, so it's pretty much flat on the week overall as we head into the Fed meeting week, and I think that will certainly move markets. And I think higher rates from here over the next 3 months, they're probably likely. This has been a big move. The market's priced in a lot of Fed cuts next year. I think something around 6 cuts. I think that's a bit aggressive. And so I think you could get a lot of gyrations more to the upside in rates as well as the dollar. And that is going to, I think, cap how far equities can really go. I still think you get more positive equity moves between now and the end of I would say the back half of the first quarter. So, call it 8 weeks. I don't see a whole lot of issues with equities, but pullbacks, moderate pullbacks are probably likely as well. So I would say from now, kind of neutral to slightly bullish over the next month or two. What else do I want to get to? Oh, credit markets. And this is why I say it. Credit markets are holding together. This is short-term junk to short-term treasuries, and that continues to power to the upside. And that means that the breakdown here during the banking crisis, as well as this recent pullback in equities, it's still making higher highs, higher lows, right? And this is fine. So there's no credit event. Credit events are really what usually creates a deflationary impulse, what creates downside in risk assets, and you're not seeing that at this point. And let me pivot over to this, which is small caps over large caps. Let's go to a weekly chart. Pretty much all of last year, small caps outperformed large caps. Not dramatically, but this was an uptrend. So this is a ratio of the Russell versus the S&P. So this is the start of 2022 right here. And for pretty much the entire year, you had the large pullback in mega cap stocks, the NASDAQ, S&P, and small caps did a bit better. Not dramatically, but certainly we're in an uptrend. But so far this year, you had large caps reassert itself to the upside on higher borrowing costs, potential increase in the default cycle, but only modestly. But the pullback in the dollar, pullback in rates, that's certainly going to help the small cap side of the market. And this is a bullish consolidation, up move from last week, and just a consolidation of pretty much this entire week. And I expect that to continue. I do think small caps will have a nice outperformance and tailwind over the coming months and probably for most of 2024. So that's what we're expecting. Let's dig into some sectors. You have industrials that has a nice snapback. You're into some resistance, but obviously the weaker dollar and lower borrowing costs are helping that part of the market. Same with the banking index that is powering to the highest levels really since the summer, right? Or above the summer highs. So that's certainly positive and helping the small cap indices. That is a big reason why you're seeing small caps get a resurgence on some relief in the treasury market. And that's where a lot of these banks are holding their assets. What else? Oh, gold. Gold had a pullback, but it's modest. This is still a series of higher highs, higher lows, and until we break below really this level, the lows from November, I expect gold to be constructive and have a decent move higher into next year. I think gold's going to do very well as the Fed cutting cycle is built into the market. We're bullish basically until the Fed cuts rates. You typically get that buy the rumor, sell the news type of event. And so far, you're starting that rumor of the Fed pausing and cutting rates. And that was what was happening earlier in the year. And then you got a deferral of that, right? Economic news came in better than expected. The Fed continued to hike rates throughout the summer, and the economic data was fine. Now you're starting to see that weakness in the economic data and the market pricing in a Fed pivot, pause, cut, whatever you want to call it, and expect that to continue to do well into next year. Let's look at growth to value. This is another aspect of I think the small versus large cap debate. And what you're seeing here, all of last year, this is a ratio. So if this is going down, that means value is outperforming growth. All of last year, and this is a longer term trend. If I go to a monthly chart, what you can see is when interest rates were next to nothing, growth crushed. Basically, when interest rates started to rise, that's when value started to outperform. All of last year, you had a little bit of you had a pretty good rally in growth this year versus value, but you're starting to see that those trends from last year reassert itself. This is now in a downtrend, right? Lower highs, lower lows, and look at the MACD below the zero line. This is starting to create a trend. And even though you had a decent market this week, you even had, the likes of Google having a good week on the back of their AI announcement. You had other parts struggle. NVIDIA did a bit better, which was a bit shocking to me. AMD also did well. But if you look at underneath the surface, look at like an Amazon, right? Amazon kind of paused. A lot of it's not, they're not breaking down, but they're breaking down relative to the broader market. So the market gets a pullback, these will likely lead to the downside. So be wary of those mega cap names. They're starting to lose their momentum. And I think a big part of it is, I talked about this on the show a few weeks ago, the hedge funds have never owned more of these large cap names ever, right? It's a very crowded trade, so there's not much more money left in, not much more juice to squeeze out of that lemon. And so I expect, if you do get a pullback in the markets, that the mega cap growth names are certainly going to lead. And those are the trends that I see. Let me see if there's anything else I want to get to. Oil's been weak on OPEC, kind of having trouble getting some cuts out of some of their members. I think it's a bit overblown. Gasoline demand did build, but overall inventory for oil remains relatively tight across the board. And I think over the next few months, I think it's going to be a good buying opportunity in the oil market. And I think that's about it. I appreciate you all tuning in to this channel. I hope you all have a wonderful weekend. A reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. Have a wonderful weekend.